Okay, so good afternoon, everyone. Welcome to today's session of financial reporting. This is Scholars and Associates, and we've already dealt with the conceptual framework last week. That is the same time. And today we'll be talking about IAS 1, and if there is time, we'll look at IAS 16, property, plant, and equipment. So IAS 1 is the presentation of financial statements. So if there is time, then we look at the IAS 16 as I said. So let's start with the IAS 1. So presentation of financial statement. IAS 1. So let's look at the objective of IAS 1. The objective of IAS 1 is to prescribe the basis for presentation of the general purpose financial statements and to ensure comparability with 1, the entity's financial statements in the previous periods, and then 2, the financial statement of other entities. So I think last week we discussed what the general purpose financial statement is. We discussed what the general purpose financial statement is. Can anyone tell us what the general purpose financial statement is? What is the general purpose financial statement? Like, what is the purpose of preparation? Why do we prepare the general purpose financial statement? Anyone to assist with that? Anyone to assist with the purpose of the general purpose financial statement? Who is helping us? Prince, can you assist with that? What is the purpose of the general purpose financial statement?
So the general purpose financial statement, that one is prepared. It's a statement prepared for those who cannot command for an information. For instance, an information that is prepared to the general public so that everyone can see and know the financial position of an organization.
Could you please come again?
The statement that's prepared for everyone. That one, everyone can see the information, the financial information position of the organization. It's prepared to the general public.
Oh, okay. So that is good. So as we said last week, that it is the financial statement prepared for those who are not in the capacity to request for financial statement, right? So that is what is prepared to the general public. And then we even use MTN statement, financial statement as an example, right? We use the statement MTN's financial statement as an example to that. So we are saying that the objective of the IAS 1 is to prescribe the basis for the presentation of the general purpose financial statement and to ensure that there is comparability with the entity's financial statement in the previous year. So why do we prepare financial statements? To ensure that there is comparability. Comparability with the company's or the entity's previous year, current year, and then the previous year. Or it could be that we are preparing it for one entity to another entity, another similar entity. So that is what the objective of the IAS 1. So if you are asked anywhere what is the objective of IAS 1, then that is the objective of IAS 1. Let's look at the scope of the IAS 1. The scope of the IAS 1. So it applies to all general purpose financial statements based on international financial reporting standards. So financial based on the what international financial reporting standard, the IFRS. It is so the IAS 1 applies to all general purpose financial statements. I believe you saw MTN financial statement, general purpose financial statement, which is available to the general public. So it covers the form and content of the financial statement, how the financial statement will look like, how it should be presented. So that is the objective, that is the scope of how the IAS 1 is. So objective of financial statements. The objective, why do we prepare financial statements? We all know that you prepare financial statements to provide information about the financial position, the financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. We want to know the position of the firm, financial position of the firm, whether the firm, looking at the firm's assets, liabilities, and then what equities. Use the firm's liabilities, equity, and then the what assets. You know the financial position that, oh, this firm is really strong. What I said, the position of the firm. Then the financial performance, to know the profitability of what the firm, especially whether the firm is making more profits or not. And then the cash flow looks at the inflows and outflows of what cash in an entity, whether the company is more liquid or it's not liquid. So the cash flow statement would tell us that. So that is useful to a wide range of what users in making what economic decisions. So that information, along with other information in the notes, assist users of financial statements in predicting the entity's future cash flows, and in particular their timing and what certainty. Their timing and certainty. So let us look at the component of the financial statement. You did this in accounting 1, the fundamentals of what accounting. We already did that. Let us go through. So a complete set of financial statements should include what? What are the components? 1, statement of financial position. The statement of financial position. At the end of the period, statement of financial position at the end of the word period. The other one is a single statement of profit or loss, another comprehensive income. In other words, comprehensive income. In the fundamentals and the introduction to accounting, you were having statement of profit or loss, right? Or the profit and loss account. Here it is profit and loss plus other comprehensive or income. You have added other comprehensive income. So if you are seeing other comprehensive income, it's added to the profit and loss that you already was know. What I said. So that is for just a period. So for the period, right? For the period. So the statement of financial position usually have accumulated amounts. The statement of financial position usually have what? Accumulated what amount. But then the financial performance or the profit and loss is usually for particular period. What I said. So we say we have the single statement of profit or loss, and then the 2 statements of profit and loss and other comprehensive what income. We also have the statement of changes in what equity for the period. Statement of what changes in what equity. Then we can talk of the statement of cash flows for the period, to know how cash flows into the organization, how cash moves in and out of the organization. And also we look at the notes comprising a summary of accounting policies and other explanatory notes. Yeah, so these are 5 key components of the financial statement. 5 key components of the financial statement. Let's look at the presentation requirements. What is the presentation requirement? Statement of financial position. IAS 1 does not prescribe the format for the statement of what financial position. There's no specified format for the financial position. Asset can be presented current, then non-current, or vice versa. So we can the current asset can come first before the non-current, or vice versa. And then the liabilities as well. And equity can be presented current and then non-current. And then vice versa, right? Yeah. Equity, you don't have current or non-current, but I mean the liabilities can be presented current or non-current, and then the equity. So some people can decide to use the net asset approach, and then some can also decide to use the total asset approach. But then here in financial reporting, unlike the fundamentals of accounting, where I was using the net asset approach, I would be using the total asset approach here more often in financial reporting. In financial reporting, I would be using the total asset approach more. Yeah. Fundamentals and introduction. Remember, I use the net asset approach, where I would say that the non-current assets, then I find the totals, then I come to the current assets, then I find the current liability, then I deduct all the current liabilities from the current assets to get the working capital. Then I add the working capital to the non-current asset. That's the net asset approach. That is the net asset presentation. That's the net asset. So certain items, line items, must be shown on the face of the statement of financial position as a minimum. Additional line items, headings, and subtotals are presented when relevant to an understanding of the financial position. So this is how it looks like. Non-current assets, property, plant, and equipment. So here we usually present the non-current assets that you know. The equipment, land and building, we group them under property. We group them under what? Property, plant, and equipment. So you can see property, plant, and equipment. It houses all the non-current assets that you know, like equipment, land and building, yeah, all those stuff. Then we have the investment property. So PPE also have its own standard, which is the IAS, which is the IAS what? The IAS 16, which we'll be looking at if time permits. And then we have the investment property as well. It also have its own standard, which is the IAS 40. And then the intangible assets, which is IAS 38. Then investments accounted for using the equity method available for the blah blah investment. Then biological assets. So these are the non-current assets items. Then we have the current assets. We have the current assets. So under current assets, we have the inventories, trade, and other receivables, cash and cash equivalents, as you know. And we can move on to the non-current liabilities, where we talk about the loan, debentures, bonds, redeemable preference shares. Then we have the deferred tax liabilities, right? So the deferred tax liabilities, sometimes you are supposed to pay your liability today, but then you defer the liability, or you defer the tax, that you pay part of it, and then the other one, the remainder will go to the previous year. So that is a liability for you because you have not fully paid your tax obligations, right? So you forward the liability. Then we have the current liabilities, which is the trade payable, current tax payable, notes payable, bank overdraft. All these are the current liabilities that you can talk about. And then the equity, we have the share capital, the share premium. Usually in Ghana, we don't utilize the share premium. So in Ghana, we have nothing like share premium. So this is for UK and other countries. So in ACC exams, that's where you usually see share premium. But in ICAG exams, they would hardly give you share premium. They will not give you share premium in ICAG exams. That is Ghana one. Then we have the retained earnings, which is the income surplus, capital surplus, equity surplus, that is other equity reserve, then the preference or shares. So all these fall under the equity component. Then the statement of profit or loss and other comprehensive income, or the income statement. So the income statement, here we have the revenue and what? Income. So we classify operating expenses into one of the following categories. Cost of sales, we have the direct material, direct labor, depreciation, amortization, and other production costs. Then the distribution and selling costs. What are some of the distribution and selling costs? You know that warehousing cost is part of the distribution and selling cost. Promotion costs, when you are promoting your product. Selling costs, transportation costs. Bad debt is also part of what? Selling costs. Because when you are selling your product, some of the customers might default the payments. So bad debts also fall under the distribution and selling costs. Then administrative expenses. Administrative expenses. And so that is the salaries, property costs, rent and rates, professional fees, other operating expenses like the finance cost, interest on loan, interest on financial instruments, income tax, blah, blah, blah. So under the component of the other comprehensive income, we already know the statement of profit or loss item, which is the revenue, less cost of sales, blah, 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 and the rest. Now, under the new addition, which is the other comprehensive income, which was not part of the fundamentals of accounting, here it looks at the changes in revaluation surplus. Actual gains and losses on defined benefit plans, gains and losses arising from translating financial statements of a foreign operation, IAS 21 year, gains and losses on remeasuring available for sale financial assets. The effective proportion of gains and losses on hedging instruments into a cash flow hedge. So statement of changes in equity. IAS 1 requires an entity to present a statement of changes in equity as a separate component of the financial statement. Yes, that is true. The statement must follow total comprehensive income for the period, showing separately amount attributable to owners of the period and to non-controlling interest. Yes, so the changes in equity get at the total comprehensive income. Total comprehensive income is when you add the profit or loss for the year to the totals of the comprehensive income. Then you get total comprehensive income for the period. Yes. So that shows the amount that shareholders can also get, and also you have the parent and non-controlling interest. So that when one company acquires another company, the one acquiring is the parent, and the entity that has been acquired is known as a subsidiary. So the subsidiary's interest So the interest that is not controlled by the parent or by the acquirer is known as the non-controlling interest. That means you have acquired this company, but this portion is not being controlled by you, the parent. The effect of the retrospective application is non-applicable for each component. Reconciliations between the carrying amount at the beginning and the end of the period for each component of equity. Separately disclosing profit or loss, each item of other comprehensive income, and transactions with owners. So this is what I was saying, that it separates the profit and loss from the comprehensive income. So at the end of the day, if whatever you get profit or loss plus the comprehensive income will give you the total comprehensive income. Will give you the total comprehensive income. And then we have the note to account. So that is the note to the financial statement. Note to what account. That is one of the components of the financial statement. Component of the word financial statement. IAS 1 suggests that the notes should normally be presented in the following order. To a statement of compliance with IFRS, it must be in compliance with IFRS. And then a summary of the significant accounting policies applied. Whatever policy you are using, whether you are using depreciation of 20%, depreciation 25%, you need to indicate it in the note to account. You have to also tell us that whether you are using the accrual basis or the cash basis. So the note to the account gives the disclosures of the relevant items that you are using in the preparation of your financial statement. So in the notes, you can tell us whether you are using the accrual basis, cash basis. In the notes, you can tell us that the depreciation is a straight line depreciation. The depreciation is reducing balance depreciation, or the sum of years they get, or any other depreciation method that you are using. You need to inform us in the notes to the account as a separate component of the financial statement. As a separate component of the financial statement. A summary of the significant policies applied, including the measurement basis used in the preparation of the financial statement. Yes. The other accounting policies was applied. Supporting information for items presented on the face of the statement of financial position. Whatever, anything that you want to tell the users of the financial information, you have to disclose it. That is not part in the financial statements. It's not part, or it's not on the face of the financial statement. You have to disclose it in the notes to the account in a writing form that this is what blah blah blah. What is it? Then supporting the presentation of the financial statement of profit or loss and other comprehensive income, statement of changes, and statement of cash flows in the order in which each statement and each line item is presented. Other disclosures, including what? So any disclosure that we want to make. So other like contingent liabilities. The liability would occur. It is dependent on what? A situation. So contingent, it is dependent. The liability will only occur when something happens. So if something does not happen, then the liability would not occur, right? And then non-financial disclosures such as entities, financial risk. Prempom, are you speaking? Gloria, are you speaking? So the non-financial disclosures, the entities, financial risk management, and policies. So let us look at the format for the financial position. The actual format for that. Actual format for that, right? Actual format for that. financial statement. Who is taking on? Who is Xavier? Could you mute your microphone? Xavier, someone who is in class. Xavier, please mute your microphone. All right, let's continue. Okay, so still under the statement of financial position, you can all see the format, right? The non-current assets, the current assets. So if you add the two, you are getting the total assets, right? That is the current total of the current plus the total of the non-current. You are getting the total assets, and then you also have your equities, total equity plus your total liabilities. Then you are going to get what? Assets is equal to what? Equity plus liability. Do you remember this equation? Do you remember this equation?
Yes, please.
Yeah, so all your assets is equal to your equity plus your liabilities. So you can see that the asset is one part, and then the equity items, you add all the equity, then all the liabilities, then you can have total equities and what? Liabilities. Total equities and liabilities. The figure here should balance with the total asset figure, right? Can you see that? So you must balance with this. So that is the total asset approach that I would be using a lot. And this is also for the income statement, the revenue less cost of sales, blah, 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 blah. All right, yeah. So here, you do adjustment to some of the items here. That is how the financial statement will be. Unlike the fundamentals and introduction, where most of the items, you bring it on the face of the financial statement. Here, revenue, maybe if you have adjustment on revenue, you do it, and then bring the total figure here. Cost of sales to you do some adjustments, and then bring a total figure here. Usually, items like depreciation, amortization are brought to the cost of sales. And then you do some adjustments, then you bring it here. Other comprehensive income, fair value surplus, blah blah blah. Then so this is what I was saying, the net income plus the comprehensive income, then you get a total comprehensive income. Total comprehensive income. Then this is how the statement of changes in equity also looks like. So here you have the stated capital, retained earnings, equity surplus, and the revaluation surplus. So here balance brought down. If you have for stated capital, the one in the financial statement, balance brought down, you have it here, you have it here, you have it there. Then net income, all your profits will go towards your retained earnings, right? The profits will go to your retained earnings, and then any dividend, you pay dividend out of your retained earnings, out of your profits, right? The dividend. When a company declares dividend, part of the dividend is given out to shareholders. When the company makes profit, part of the profit is given out as dividend to the shareholders, and then the remaining is retained in the business. Is retained in the business. So the dividend, you less this. Then you have the fair valuation surplus. So that one can go to the equity surplus, and then the closing balance. Then you have the what? 2,000. So that is it. So we are done with the IAS 1 presentation of financial statement. That is basically that. That is basically that. IAS 1 done. We are done with IAS what? 1. IAS 1.